There are always high dealing costs in the property market because if you think about it, to buy a property and then sell it, what are you looking at? I mean, your agent, your estate agent is going to charge you probably 4 to 6%. So you're probably looking at 12% to get in and out of a property. In the share market, your turnaround dealing costs, that's to get in and to get out of a share, are about 3%. So that's a significant difference if you're thinking about investment over the long term. But the real problem with property is that shares pay dividends, but property has tenants and pays rent. So if you have tenants, you're going to have trouble. Tenants always produce difficulties. First of all, they often don't pay the rent, and secondly, they're going to trouble you about all sorts of maintenance problems. They'll want you to come and fix the toilet in the middle of the night. My share certificates never do that. I buy the share certificates, they sit in my bottom drawer, and they don't give me any problems, and when the time is due for them to pay the dividend is simply paid automatically into my bank account. There's no such thing as a share not paying out its dividend to its shareholders. If the dividend has been approved and declared by the directors, then you get it automatically. So those are some of the problems. If you really do want to get into property, you can always buy shares in a good property company, a real estate investment trust as they're called now, or a REIT. So I prefer the share market to the property market. But of course there are a number of different ways to get into the share market. Most people are chipping a little bit of money into unit trusts or into an insurance policy every month. So I want to just look at those different vehicles or those different methods of going into the share market. If you put money into an insurance policy, then the insurance company will take your money and combine it with the money of many, many other thousands or hundreds of thousands of individuals, pool that into great lump sums which they then place onto the Johannesburg Stock Exchange. There on the stock exchange they can make 30, 40, 50% per annum, and when you turn 65 or whatever the date is on your policy, they will give you your money back plus 12% if you're lucky. What we are suggesting is that you eliminate that middleman. You see, because that extra profit goes to their shareholders, to the insurance company's shareholders. And clearly, if you can eliminate that middleman and go directly into the share market for yourself, you will do better. So we always advise that you should rather buy the shares of the insurance company that's trying to sell you that endowment or insurance investment policy, rather than buying its policies in the open market. I have always preferred to be on the side of the owners rather than the clients when it comes to insurance. Now, unit trusts are better than insurance policies, mainly because you can sell them whenever you want to. I don't know if you've ever tried to get out of an insurance policy, but if you have, you'll know that it's very expensive and very difficult to do that. You have to provide reasons, and it takes a long time, and there are penalties that you have to pay in the process. At least a unit trust you can sell whenever you want to. But the unit trust industry is not great for a number of other reasons. One factor that you may not know is that most unit trusts underperform the JSE overall index. So ask yourself this question: why am I investing into a unit trust? Usually it is because you believe that the unit trust has a group of managers who will manage your money more effectively than you could if you took it directly into the share market. But if that is the case, why is it that 4 out of 5 unit trusts in South Africa underperform the indexes or the averages of the Johannesburg Stock Exchange? I mean, really, you have to pay a fee to these people to manage your money. Why would you pay a fee to somebody to underperform the average of the stock market? If you want to underperform the average, you can do that for yourself, I'm quite sure. I mean, theoretically, the chimpanzee in the Pretoria Zoo should be able to do it better, or a man using a table of random numbers should be able to do it better. So I really don't like unit trusts, and I don't like insurance policies as savings vehicles. And those are the traditional, normal savings vehicles. that are available to the man in the street. Those are your ways to get into the share market. But there is another way, and that is to open your own stockbroking account and invest your own money on the JSE for your own benefit. And it's much easier to do that than you would think. You need to have about 5,000 to 10,000 Rand of cash, and you go and open a stockbroking account with a stockbroker, and there are about 40 different stockbrokers registered on the Johannesburg Stock Exchange. Most of them will take private clients. You can also open a stockbroking account through your bank. That has the benefit that when you open the account, you won't have to produce a proof of residence to open that account. You can just open it automatically. You can often open it online. The problem with banks is that they are banks. They are not stockbrokers. So they tend not to understand the share market or the immediacy and importance of shares. They tend to treat a stockbroking account the same as a bank account, and that can be a problem you'll find. Personally, I prefer to open an account with somebody like PSG Online, who have been in the stockbroking business for decades and decades, and they really understand shares and all the different mechanisms that you'll find in the share market. So once you've got that stockbroking account open and you've put maybe 5,000 or 10,000 Rand in there, obviously your next problem would be to choose some shares and put your money into those shares. You shouldn't really buy shares with less than 5,000 to 10,000 Rand, because in that case your dealing costs would be too high a percentage of your investment. In other words, you would have to have that share go up to quite a long way before you were in the money, before you started to make a profit out of it. All right, I'd now like to just talk a little bit about whether you should be a long-term investor, buy and hold, or whether you should be an active investor, somebody who is involved and watches the share market all the time. Now, to deal with that, I need to take you back to 1969. At that time, the stock market reached a very high level, and from that high level, it began a long downward trend. So now, if you were a person who just bought your shares and held them indefinitely, if you bought them right at the top of that trend, it would have taken you 20 years in inflation-adjusted terms for the share market to reach that same level. And that, of course, is an awful long time. Most people do not, even if they regard themselves as long-term investors, they do not want to wait 20 years for a real return on their money. So it's like everything else in your life. You make money from your profession because you understand it, you're knowledgeable about it, and because you're actively involved in it. You will make money from the share market when you understand it and when you're actively involved, not before. So there's no free lunch here. All right, let's now move on to some of the techniques that you could use in the share market. Now, most people are scared of the share market. They believe it to be a highly risky place. And the thing that they don't understand is that there are mechanisms for controlling and managing your risk in the share market. And I'd like to tell you about one of those mechanisms tonight. That mechanism is called a stop-loss strategy. Now, a stop-loss strategy is a little bit like the seat belt you put on when you get into a motor car. You don't put on that seat belt because you're expecting to have an accident this day. I mean, if you're expecting to have an accident today, you wouldn't get into the car in the first place. So the seat belt is really there to protect yourself against the unexpected. Somebody jumps a robot in front of you or something like that. So a stop-loss strategy is the private investor's seat belt in the stock market. That's what it is. And it works in a very simple way. If you look at your screen now, I'm going to show you some things here. Catherine is going to help me show you some things. I'm a bit technically challenged, so you'll just have to bear with me. Right, now you can see on your screen, I've put the heading there, stop loss. Now, imagine that you are looking at the share market and you find a share which you really like. And let's say it's trading in the market for 10 Rand, right? Now you should see 10 Rand on your screen if you're very lucky. Now, let's say you've done your homework, you've studied the balance sheet, you've looked at the charts for the share, and you really like the share and you want to buy it for 10 Rand. But you could be wrong. You might have chosen the wrong share, or you might have chosen the wrong time to buy the share. So we recommend that to cover that situation, you set up a stop loss strategy. You mark off 10% below that current market price of 10 Rand, and you say if the share falls from this price at 10 Rand down to 9 Rand, then clearly my decision to buy it here at 10 Rand was a mistake. I made a mistake, at least in my timing, if not in both in my timing and my selection. So I will therefore acknowledge my mistake by selling the share at 9 Rand and thereby protect the bulk of my capital. So that, in a simple terms, that's how it works. But let's suppose that the share doesn't go down. Let's say that you got it right and it goes up. Let's say it goes up to, shall we say, 15 Rand. Now, we advise that you should maintain that stop loss level behind the current market price. So when it's at 15 Rand, you mark off your 10%, so your stop loss is set at 13 Rand 50. Now, if the share turns and starts to fall, when it reaches 13 Rand 50, you sell out of it. Because the one rule about stop loss levels is that you cannot move them down. You can only move them up. So they work like a ratchet that can only move up and can't come down. So when you get to 15 Rand, if the share turns and falls and it gets to 13 Rand 50, you sell out and thereby lock in your profits of 3 Rand 50 at that moment. So I'm hoping that you understand how the stop loss works. All right, it's a very simple mechanism. The one question you may be asking yourself is, why 10%? I mean, why do I have a 10% stop loss? Why not 12% or 5% or some other number? To answer that question, I need to ask you a question. How much are you willing to lose? If you tell me you're willing to lose nothing, then you must put your money into the post office. It's the safest place to lose money. It's absolutely guaranteed. But you see, if you want to make money, you have to take some risk. And the point about a stop loss strategy is it absolutely defines how much you're going to lose. Because when you've lost your 10% or whatever percentage you choose, then you're going to stop out of that share and protect the bulk of your capital. So your downside risk is limited to 10%. But why 10%? Why not 5%? Well, to be quite honest with you, the only reason I chose the 10% is because it's easy to calculate. Personally, on my own portfolio, I don't like to lose more than 15% on any stock market investment ever. And that, by the way, includes my dealing costs of 3%. So my stops are never set more than 12% out at an absolute maximum. All right, now let's consider some of the effects of the stop loss strategy. I've drawn a line here on the screen, and this line is there to represent the JSE overall index from 1916 to 2016, so over a 100-year period. And of course, that index has gone up over that period. It's gone up by approximately 13.8%, plus or minus 13.8% per annum over that whole period. So it's 100 years. Of course, it didn't go in a nice straight line like this. There were booms and busts and so forth, but this is the average performance. Now let's suppose for a moment that you are a complete beginner. You know absolutely nothing about the share market. So you're going to choose your shares completely at random. You're going to take the price page out of the newspaper with all the share prices on it. You're going to pin it up on the wall. You're going to stick it to the wall. You're going to tie on a blindfold. You take some darts and throw them at that price page, and where they land, that's what you're going to buy. So if you choose your shares completely at random, then you would expect that half of those selections will beat this JSE overall index, and the other half will underperform it. I mean, that must be true, isn't that so? Because this is an average of the shares from which you are selecting. So now, if on the half that outperform the index, you can make 100, 200, 300% or more, but on the half that underperform the index, you cut your losses at 15%, then can you see that so long as you have a strict stop loss strategy, even if you choose your shares completely at random, you are going to beat this index. You're going to beat it. And that is something that, remember, 4 out of 5 unit trusts cannot do. So you might also be thinking about using somebody like a portfolio manager or maybe your stockbroker to manage your money for you in the share market. And on that point, I would just like to give you this word of advice. Nobody cares about your money except you. I don't care about your money. I care about my money. You care about your money. So therefore, you should educate yourself in the art of share market investment and teach yourself to get into control of your own financial affairs rather than paying somebody else who doesn't care to look after your money. I hope you've understood the stop-loss strategy well. It's a very important thing for you to understand, because I'm sure you can see that if you choose your shares, even if you choose them at random, which of course you're not going to do, but even if you choose them at random, you should be able to do well in the share market just by applying a strict stop-loss strategy. Now, sometimes people don't implement stop-loss strategies because they just don't seem to have the willpower to do it. Many years ago, I went down to Durban and I was delivering a lecture down there, and part of my lecture was to discuss a stop-loss strategy. And while I was talking, when I had finished talking, a gentleman came up to me and he said he had a huge problem. And I said, well, what is your problem, sir? And he said, well, I bought a large parcel of a certain share at R2.25, 225 cents per share. And he said those shares have now fallen to 168 cents per share. So I've made a big loss. And he said, I see what you say about stop loss, and it makes perfect sense. But what must I do now? What must I do in this position that I'm in now? And I said to him, well, sir, your problem is that you are carrying that loss that you've made around with you like a great ball and chain. It's paralyzing your mind. You can't think, you can't sleep. You're worrying about this loss all the time. And I said, the only way to get rid of that ball and chain is to sell the share, because then you cannot continue to pretend that you didn't make a mistake. But when I said that to him, he buried his head in his hands and he said, oh, I can't sell now, not now. So I said to him, well, there is one other thing you could do. Pretend that you bought the shares today at R1.68, establish your stop loss level, and go forward from here. Anyway, about 6 months later, I was down in Durban again, and I met the same guy. And you know, he still hadn't sold those shares. Only by that time, they were trading for 68 cents. So you see, some people have to pay more school fees than others. You can hear what I'm saying now about stop loss, or you can go out there and find it out for yourself. But the point about stop loss is that it reduces your risk in the share market significantly. It is one of the great benefits of the share market, is that you can apply a stop loss strategy. I mean, imagine if you could go to Monte Casino, to the roulette table, and apply a stop loss strategy. First of all, the casino will go out of business overnight. And secondly, you won't be able to lose. Every time you lose, you'll only lose 15%. Every time you win, you'll double your money or triple it. And yet here you've got a market which goes up on average 13.8% per annum. So already your probability of choosing a winner in the share market is higher than your probability of choosing a loser. And you can apply a stop loss strategy. So you can understand why I believe the share market is a very solid, safe investment avenue for most people. Now I'd like to continue and talk a little bit about your problem in the share market of buying low and selling high. I mean, that's really what you want to do, isn't it? You want to get in at the bottom of a trend, hold the share, and then sell it somewhere at the top of the trend. So let's look at the cycle and see what's going on here. Let's have a look and see what's going on. I want to draw one of these nice cycles on your screen that you don't often see in the share market, but it is useful for explaining my point. And of course, this is a share going up and down through the cycle, you see, and the share has what we call a real value. Now, some people, some investors might say that there's no such thing as a real value for a share. But the same investor, probably in the same breath, will say that such and such shares are overpriced or underpriced or expensive or cheap in relation to what? In relation at least to his perception of their real value. And you and I, we know that shares oscillate from being overpriced to being underpriced and back again. That's just common sense, isn't it? So, let's consider the cycle. Let's have a look at this cycle and see what's actually going on. Now down here, at the lowest point, the smartest money is buying the share. By definition, these are the people that have done their homework, they've studied the balance sheets and income statements, they've looked at the charts, and so they buy the share at this bottom point. Your objective is to get into the trend somewhere near where they do, so that you can benefit from the upward cycle. So they are the smart money. They are buying at the bottom of the cycle. And their transaction will move the share up a little bit. And it will move the share up, say, from there to here, at which point we'll get another group of investors coming in who are not quite as smart as these guys who bought at the bottom. But they're still pretty smart. They also did their homework. The difference is that they needed that little move there to act as a confirmation, you see, before they bought in. And their purchase, in turn, moves the share market up to there. So now we've got another group of investors who are, again, not quite as smart as the second lot, and they're buying in here, and their transaction moves us up to here. And so we go on up the cycle with less and less smart individuals getting in at each point. And then at some stage, we cross this magical barrier, this real value line, and the share becomes overpriced. And that's the interesting thing about the share market. It continues to go up with less and less smart individuals getting in at each point. Or you might say actually more and more stupid individuals getting in as we go up. Now right at the top here, you've got a guy, let's call him Joe Citizen, and he buys into this share. But Joe Citizen is a music teacher. Let's suppose he's a music teacher. He knows nothing about the share market. He doesn't read any business publication. But let's say he's in the dentist's waiting room today, and he's stuck in there, and he's bored and he's waiting for the dentist, and on the table is a copy of the Business Day, which is the Johannesburg business newspaper, the South African business newspaper, and he picks it up and he starts reading. And on the front page is an article about this share. And it's a very nice article. It says what a wonderful company it is, fantastic management, they've got new products coming out, they're beating the competition to hell, they've covered forward on their foreign exchange, it's really an amazing company. And Joe Citizen looks at this, and of course the article contains a graph as well. But you understand that the graph just shows you this first 6 months. It doesn't show you the rest. And what Joe Citizen sees is he sees a share price that has doubled in the last 6 months. And that to him is the proof. I mean, that means that this share is a winner. Everyone is buying this share. So anyway, he quickly picks up the phone. He asks the receptionist if he can borrow her phone, and he phones through to his bank manager, and he arranges an overdraft on his bank account. Now the bank manager, of course, will look on his computer and see that Joe Citizen owns his own house. So he's quite happy because that represents collateral. So he extends Joe Citizen's overdraft. Then Joe Citizen phones his stockbroker and he says, I've got to have some of these shares. And the stockbroker has no problem with that because, of course, he gets a percentage of the value of the transaction in his brokerage fees. So Joe Citizen finds himself the proud owner of a large parcel of these shares. He tears the article out of the newspaper and he rushes home to his wife. And he says, look at this. We're going to be rich. We're going to make money. I mean, look at this share. The share price has doubled in the last 6 months. I mean, they've got fantastic management. They've covered forward on their foreign exchange. He doesn't really understand what that means, but it sounds very impressive. Anyway, his wife is not very sure of what he's done. All she can see is that he's spent a lot of money on something that they really can't afford and which he doesn't understand. So after a while, Joe Citizen gets frustrated. He realizes he's not getting the sort of enthusiasm from his wife that he was expecting. So he leaves home and he goes down to the pub and he talks to his mates at the pub. And the whole evening, he's extolling the virtues of this share. He's saying, these are fantastic shares. I mean, look how the share's gone up. Look how it's doubled in the last 6 months. And he's talking about how they've covered forward on their foreign exchange, how they've got new products, management's fantastic, and so on. Anyway, as you and I know, at around about that time, the cycle turns and the share starts to fall. And here you can see how it begins to fall. At first, Joe Citizen is blasé. He says, well, obviously it's just a correction in an overall bull trend. You can see how he learns the language of the stock market. But it doesn't get better. It, in fact, gets worse. And it gets worse, and it gets worse, and it gets worse. And now his wife's on his back because, she could have bought a new motor car with that money. And what's he doing? Fooling around with something he doesn't understand. She's quite right, of course. And it gets worse, and it gets worse, and it gets worse. And now the guys at the pub are laughing at him. When he comes in, they open the newspaper and they say, well, how much did you lose today? And it just gets worse and worse. And eventually Joe Citizen just can't take it anymore. He just can't take it anymore. So he decides to sell the shares. And of course, we all know who buys it back from him, don't we? The smart money that bought it in the first place. Now you can see that this cycle goes on in the share market year in and year out. And it will continue to go on for so long as we have people with different levels of knowledge and experience. And of course, your objective is to find and buy the share at the bottom so that you can take advantage of this upward trend. You see, this is what I'm talking about. So if you want to do that, you must get in somewhere near to the bottom. Now, if you want to get in at the bottom, it means that you must find the share over here when it's falling. So that when this moment comes, you are ready and waiting for it. You're ready and waiting. So you need to change the way that you go about thinking about the share market. You see, there's a great difference between beginners in the share market and professional investors. A beginner gets excited when the share is going up, like this period over here. A professional gets excited when it's going down. That's the difference. So tonight I want you to change your approach to the share market. I want you to start looking for the bad news in the newspaper. If you see a headline like, strike hammers ArcelorMittal, get excited, because that might mean that that share is underpriced and cheap. And you should start watching that share and waiting for this critical moment so that you can pick them up at the bottom of their trend and thereby benefit from the next upward cycle. All right, now I just thought I would actually show you a portfolio. So now let's go to, I've got another, is that it? It says problem loading page. Refresh. Right, got it. Resend, confirm. Okay, I know I'm loading the page again that I had here. It seems to have clocked out of it. What I want to show you is one of my portfolios in the stock market so that you can get an idea of how a stock market portfolio looks. When you open that portfolio, you need to ask them to give you internet access to your portfolio so that you can it looks like I've got a problem with this. I can't get into that particular thing at the moment. Somehow we've been logged out. All right, never mind. I'm going to show you some charts on ShareFriend now. This is our software, and what I'm showing you here on the screen now is the S&P 500 index. This is a very, very important index. I'm going to put a lot more data on the screen now so that you can see this chart over the previous 10 years. Okay, so now you can see the last 10 years. And you can see that since March 2009, and you can see that date in the top left-hand corner of your screen there, 11/3/09, where my mouse is now, right up to today, because this is right up to today's date, the 28th of, that doesn't look quite right. Sorry, the 20th of September 2009, around the 20th of September 2009, you can see that we've been in a long upward trend on this share, on this index. Now, the S&P 500 is the average of all the shares of the 500 biggest shares trading on Wall Street. And I'm bringing in more data from the left-hand side of the screen. So you can see how this is quite cyclical. You have upward trends and downward trends, and we're now currently in a long upward or bull trend. What's happened? Okay. Sorry, we're having a few technical problems. It's very important for you to watch this S&P 500 index because this is what will tell you whether the Johannesburg Stock Exchange is in a bull or a bear trend. Because when Wall Street is in a bear trend, that's where the S&P 500 is, then the JSE will be in a bull trend too. And in a bull trend, 80% of the shares on the JSE will be rising. In a bear trend, 80% will be falling. You can also see on this chart that I can quickly add a moving average to give me an idea of the long-term trend in this share. There's the moving average. I put on a 200-day moving average. I will explain how the moving average works in another later seminar. But this shows you how the moving average smooths out the underlying trend and gives you an indication of whether you're in a long-term bull or bear trend. Let's take a look at another share on ShareFriend. I'm going to look at Sasol, for example. Here is the Sasol share price. What you're looking at is a candlestick chart. I'm going to change that just to a line chart so it's easier for you to understand. And you can see here how Sasol has been for the last 2 years operating in a trading range between a resistance level at about 490 Rand a share and a support level at about 360 Rand a share. And you can see every time it reaches this resistance line, it falls back, and every time it reaches the support line, it goes up again. So now we are quite close to that support line, and it looks like Sasol is at a good time to buy into the market. Of course, Sasol depends on the Rand, the strength of the Rand against the dollar. So we need to also consider that in our analysis. So now I'm going to look at the Rand quickly. This is a long-term chart of the Rand, and here you can see how the Rand has been weakening steadily over the last 5 years. And you can see that this trend line has been supported by many touch points, beginning over here, and there, and there, and there, and all these different touch points. So it's a very reliable trend line, including this touch point over here, which is very recent. This spike where the Rand weakened dramatically was caused by Mr. Zuma firing the finance minister, Mr. Nene, and then obviously Pravin Gordhan took over as finance minister, and since then the Rand has been strengthening, but you'll notice it came back to this trend line, bounced off it, and is currently back in its sort of longer term weakening trend, we believe. So obviously if you're going to buy Sasol shares, because Sasol is getting most of its income in US dollars, it depends heavily on the Rand. If the Rand falls, it makes more money. If the Rand rises, it makes less money. So obviously you need to have a view to the Rand as well. So there's a little bit of insight into how our ShareFriend software works and the kind of things that you can use it for in order to help you to find shares and to time your transactions for the best profit. Okay, if you have any questions, I'll wait for a few minutes now. Please type them into the chat box on the right-hand side of your screen, then I'll answer them directly. Anyway, thank you very much for listening to our seminar. We will have other seminars in the future, so watch our website for the dates and times of those seminars. Good night.